You're sitting across the desk at the bank, trying to look calm. You've got a steady job. You pay your bills, mostly on time. So when the loan officer pauses, looks at the screen, and quietly says, "The rate is higher than you hoped," your stomach drops. Somewhere in a system you've never seen, 3 little digits just spoke for you, and they said, "You're a risk." Tonight, let's talk about what a bad credit score really costs you in Canada and how you climb back out of it. Maybe you've felt this before. The application that got declined for no clear reason. The deposit a landlord asked you for that your friend never had to pay. It feels personal, like someone looked at you and decided you weren't good enough. But it comes down to a score, built from a small handful of habits, and most of them you can change. By the end of this, you'll know what the number actually is, what it's quietly costing you, and the plain steps that pull it back up. So let's start plain. Your credit score is a 3-digit number that tells a lender how likely you are to pay back what you borrow. In Canada, it runs from 300 to 900. Higher is better. Roughly speaking, anything above about 760 is excellent. The high 600s and up is solid. And once you slip into the low 600s and below, lenders start to get nervous. The exact cutoffs shift from one lender to the next. But the idea is simple. The number is their best guess at your risk. 2 companies keep this score in Canada, Equifax and TransUnion. They're called credit bureaus, and they quietly track how you borrow. Every credit card, car loan, line of credit, and phone plan can report to them whether you pay on time, how much you owe, how long you've had each account. Your bank doesn't set the score. The bureaus build it from that history. And here's the part that catches people off guard. Your 2 scores can differ because not every lender reports to both, so it pays to know both of your numbers. Now, what actually moves the number? The biggest piece by far is your payment history. Do you pay on time, every time? One payment that slips 30 days past due can land on your report and sting for years. This is the part lenders care about most because it's the clearest sign of what you'll do next. Pay on time, month after month, and you're building the single strongest part of your score. Nothing else you do for that number matters quite as much as this. The second big piece surprises people. Lenders look closely at how much of your limit you actually use, not just what you owe. They call it your utilization. Say you've got a card with a $10,000 limit and you're carrying $9,000 on it. You're using 90%, and that screams stress to a lender. The rule of thumb is to keep it under 30%. On that same card, that means staying under $3,000. Lower is better. Paying it down before the statement closes can lift your score faster than almost anything. 3 smaller things round it out. First, the length of your history. An old account with years of on-time payments carries weight, which is why your oldest card is worth keeping. Second, your mix of credit, like a card and a loan, shows you can handle more than one kind. Third, hard inquiries. Every time you apply for new credit, a lender pulls your file, and a cluster of applications in a short stretch can ding you. One honest thing to know: the bureaus don't publish their exact recipe. These are the factors that matter, in rough order. So what does a low score actually cost you? Start with the big one: a mortgage. Picture 2 Canadians buying the same house, each borrowing $500,000 over 25 years. The one with a strong score might land a rate near 4.5%. The one with a weak score gets pushed to a lender charging 6.5%. That gap is about $600 more every single month. Over the whole mortgage, it's roughly $180,000 in extra interest. Same house, same income, one number 180 grand apart. Now, your car. Say you finance $30,000 over 6 years. With good credit, you might get a rate around 7%. With poor credit, a subprime lender can charge 15% or more. That's well over $8,000 in extra interest for the exact same car. And think where that money could have gone. $8,000 dropped into a low-cost index fund inside your TFSA, then left alone for years, grows into real money. A bad score costs you that interest today and quietly takes from your future savings too. It doesn't stop at loans. Your score leaks into everyday life. In many provinces, home and auto insurers can pull your credit when they set your premium, so a weak score can mean a higher quote. Sign up for a phone plan, and the carrier often runs a credit check. Poor credit can mean a deposit or a flat no. Rent an apartment, and more landlords are pulling scores than ever. A low one can lose you the place or cost you an extra month up front. The number quietly follows you everywhere. Now, let's kill some myths that keep people stuck. The first one is everywhere. People believe checking your own score will lower it. It won't. When you look at your own number, that's called a soft check, and it has zero effect on your score. Only a hard check, when a lender pulls your file for an application, can nudge it down a little, so you can look at your own score every week if you want. Watching it closely is one of the safest, smartest things you can do. Here's the myth that costs people the most. Plenty of Canadians believe you have to carry a balance on your credit card and pay interest to build your score. You don't. Paying your balance in full every month builds your score just fine, and it saves you the interest. The card company reports that you used the card and paid it off. Carrying a balance month to month does one thing for sure. It hands the bank 19 or 20% interest. Pay it off. Your score won't mind one bit. One more myth, and it's a sneaky one. When people clean up their finances, they often cancel old credit cards they don't use anymore. It feels responsible, but closing an old card can actually hurt you. You lose that card's limit, so your utilization jumps overnight, and you shorten the average age of your accounts, which the score quietly rewards. If a card has no annual fee, the easy move is to keep it open, put one small bill on it, and pay that off automatically. An old, quiet card sitting in a drawer is doing more for you than you'd think. So how do you actually pull the number up? None of it is fancy. It's a few boring habits, repeated. Start with the biggest lever. Pay every bill on time. Set up automatic payments for at least the minimum on every card and loan, so a busy month never costs you. One missed payment can undo months of progress, and the fix is a 5-minute setup inside your banking app. Do this single thing, and you've already handled the part of your score that matters most. Next, bring your utilization down. Pay your cards before the statement date, not just the due date, so the balance they report stays low. If you can, ask for a higher limit, and then don't use the extra room, which drops your ratio. Space out your applications instead of chasing every shiny offer. Credit isn't repaired in a weekend. Most people see real movement over 6 months to a year of steady habits. The score climbs slowly, and then one day you finally qualify for the rate you wanted. And you don't have to pay to watch your progress. Plenty of Canadians check their score for free. Apps like Borrowell and Credit Karma show you a score at no cost, and many of the big banks now display it right inside their app. Equifax and TransUnion will also give you a free copy of your credit report if you ask. Read it carefully. Errors are more common than you'd expect, an account that isn't yours, a payment marked late that wasn't. Disputing a real mistake is one of the fastest ways up. So come back to that desk at the bank. Your credit score is the price tag a lender reads before you say a single word. It quietly decides what you pay for a home, a car, even your phone, and your rent. A low number can cost you tens of thousands of dollars over a lifetime. The good part is that you hold most of the controls. Pay on time, keep your balances low, leave your old cards alone, and check your number for free. None of it is fast. All of it works. If this made the number finally make sense, subscribe so the next Canadian Money Breakdown finds you. Take care of yourself, take care of your people, and start building that score this week.